What if I told you there's a massive Chinese tech giant with over 1.3 trillion yuan in revenue, a nationwide logistics network that even Amazon would admire, billions in cash on the balance sheet? Yet today, the market values it like some boring supermarket chain? JD.com, once one of China's fastest growing e-commerce champions, is now trading at a forward PE of just 8 and a price-to-sales ratio of only 0.25. Yes, 0.25. That's cheaper than most retail REITs, and the company isn't even in decline. So why is one of the largest online retailers and logistics operators in the world trading this cheap? And more importantly, is this the hidden value opportunity that investors have been ignoring? JD.com isn't just another e-commerce company. It's one of the most important retail and logistics infrastructures in China. But its origins are much simpler and surprisingly humble. The story began in 1998 when founder Richard Liu Qiangdong opened a tiny retail shop in Beijing's Zhongguancun electronics market. Back then, JD wasn't online. It sold CD burners and electronics, just a small brick-and-mortar business run with razor-thin margins and ruthless discipline. Everything changed in 2003 when the SARS outbreak hit China. Foot traffic disappeared overnight. Physical stores were empty, and businesses across the country were collapsing. Richard Liu had two choices: shut down and wait, or reinvent. He chose the second path. He put JD's products online and began selling directly to customers nationwide. Within months, he realized something powerful. Customers didn't just want low prices. They wanted trust, genuine products, fast delivery, and a smooth shopping experience. So JD doubled down on authenticity and speed, two things that eventually became their biggest advantages. By the late 2000s, JD began building its own warehouses, delivery stations, and eventually its own nationwide courier network, something Alibaba never did. Today, JD's logistics arm operates one of the largest automated fulfillment networks in the world, including smart warehouses, robot delivery vehicles, and next-day coverage across almost all major cities in China. From a one-room electronics shop to a 1.3 trillion yuan e-commerce empire, JD's transformation wasn't driven by luck. It was built on relentless execution, operational efficiency, and decades of investment into physical infrastructure. This is why JD isn't just a retailer. It's a supply chain giant, a logistics powerhouse, and a trusted shopping platform for hundreds of millions of Chinese consumers. Let's take a closer look at where JD.com's money really comes from, and what that tells us about the company's long-term strength. Starting with the business segment breakdown, the picture is very clear. JD Retail absolutely dominates, generating 945 billion renminbi, or roughly 83% of JD's entire segment revenue. This is the heart of JD. Direct sales, guaranteed authenticity, and a massive product catalog that consumers trust every single day. Next, we have JD Logistics, contributing 166 billion renminbi, or about 15%. This isn't just a delivery service. It's a nationwide, highly automated supply chain network that JD has been building for almost 20 years. Logistics is JD's biggest competitive moat, and increasingly, a service they sell to other businesses as well. The remaining slices, data and new businesses, make up less than 3% combined. They're small today, but represent JD's future bets: on-demand delivery, innovation, offline retail experiments, and new consumer channels. Now, when we shift to the products versus services revenue mix, you'll notice another important trend. Product sales still dominate, bringing in 871 billion renminbi, or about 80% of total revenue. This includes all the physical goods JD sells directly: electronics, home appliances, FMCG, and groceries. But look at the other slice. Service revenue already accounts for 20%, or 213 billion renminbi, and this part of the business is becoming more meaningful each year. It includes logistics for third-party merchants, marketing services, platform fees, and other value-added offerings. Why does this matter? Because service revenue typically carries higher margins. As JD grows its logistics business and strengthens its platform ecosystem, this 20% slice has the potential to expand significantly, which means better profitability and more resilient earnings in the future. So when you put both charts together, the story becomes clear. JD is a retail and logistics powerhouse today, but quietly transforming into a more diversified, service-driven business. And that shift is a key reason why many investors believe JD.com is undervalued compared to its long-term potential. Now let's break down JD.com's financial performance over the last 6 years, because this is where the investment story becomes very clear. Starting from the top, JD's revenue has been growing steadily, rising from 746 billion renminbi in 2020 to almost 1.16 trillion renminbi in 2024. This is not a company in decline. This is a company still expanding at scale despite competition from Pinduoduo, Douyin, and Alibaba. Next, look at net income. Yes, JD had a loss in 2021, but that year was an anomaly caused by one-off investments and write-downs. What matters is what happened after that. Profits rebounded sharply, growing from just 10 billion renminbi in 2022 to 24 billion renminbi in 2023 and hitting 41 billion renminbi in 2024. That is a 4x recovery in 2 years, and the market still isn't pricing this in. Then, you'll notice the improvement in operating profit and margin. Operating margin climbed from only 0.4% in 2021 to 3.4% in 2024. That may look small, but for a direct sales retail business operating at scale, even a 1% margin improvement translates into billions of extra profit. This shows JD is managing costs better, tightening operations, and focusing on profitable growth instead of burning cash. Another major highlight is cash flow. JD consistently generates over 40 to 60 billion renminbi in operating cash flow every year. Free cash flow remains strong as well, even after capital expenditure, giving JD the flexibility to pay dividends, buy back shares, and still have deep liquidity. Speaking of liquidity, JD's cash and short-term investments now stand at a massive 234 billion renminbi. That's more than many entire listed companies are worth. This strong cash position is one of the biggest reasons analysts say JD is undervalued and financially resilient. Debt? Almost a non-issue. The debt-to-equity ratio stays low, around 0.2 to 0.3 times. JD is not overleveraged. It's disciplined, cash-rich, and operationally robust. EPS also follows a recovery trend, rising from 6 renminbi and 40 cents in 2022 to 26 renminbi and 90 cents in 2024. That's a sign of improving profitability and share buybacks, reducing dilution. And finally, JD has started paying consistent dividends since 2022. This includes special dividends in good years, showing confidence in their cash flow and commitment to return value to shareholders. So when you look at this entire table side by side, a clear pattern emerges. Revenue is stable and growing. Profitability is recovering strongly. Cash flow is consistently positive. The balance sheet is extremely strong. EPS and dividends are trending up, yet the stock still trades at a forward PE of around 8 to 9 times. This gap between strong financial fundamentals and low market valuation is exactly why JD.com is increasingly seen as a deep value opportunity in the Chinese tech sector. Now let's look at JD.com's valuation metrics over the last 5 years. And this part is extremely important because this is where the disconnect between price and fundamentals becomes very obvious. Start with market cap. Back in 2020 and 2021, JD was a $1 trillion giant in Hong Kong terms, worth over 1 trillion Hong Kong dollars at its peak. But fast forward to today, and its market cap has collapsed to around 320 billion Hong Kong dollars. Even though revenue is higher, profits are stronger, cash levels are bigger, and the business is more efficient. This is not a collapse in fundamentals. This is a collapse in sentiment. Then look at enterprise value, which includes debt and subtracts cash. JD's EV fell from almost 1 trillion Hong Kong dollars in 2020 to just 227 billion Hong Kong dollars today. This essentially means the market is valuing JD's trillion yuan retail and logistics empire at the price of a mid-sized company. Next, the price-to-book ratio tells a similar story. In 2020, JD traded at almost 4 times book value, a premium you expect for a fast-growing tech giant. Today, It trades at around 1.0 times book value, basically at NAV or the value of its assets. That is extremely rare for a business with nationwide logistics infrastructure, 1.3 trillion yuan in revenue, and a massive customer base. Now look at the P/E ratio. 5 years ago, JD traded at high multiples, sometimes 18 times, sometimes above 50 times depending on earning cycles. Today, the stock sits at single-digit P/E levels, around 9 to 11 times earnings. For a profitable cash flow-generating e-commerce giant, that's deep value territory. Then we have EV/EBITDA and EV/sales, which show the biggest transformation. JD used to be priced like a high-growth tech stock, with EV/EBITDA above 40 times and EV/sales above 1 times. Today, EV/EBITDA is around 4 to 5 times, and EV/sales is barely 0.16 times. That's not a tech stock valuation anymore. That's how the market prices supermarkets and low-growth retailers. And finally, look at ROIC and ROI. JD's return on capital has been gradually improving. ROIC climbed from low single digits to over 6% at its peak, a sign that JD's investment into logistics and retail infrastructure is finally paying off. Even though TTM dipped due to food delivery investment, the overall trend is still positive. So when you put all these metrics together, the message is clear. Market cap collapsed. Valuation multiples collapsed. Price to book collapsed. EV/EBITDA and EV/sales collapsed. But JD's revenue, profits, and cash flow did not collapse. This is a definition of a sentiment-driven undervaluation, not a business deterioration. And that's exactly why JD.com is increasingly viewed as a deep value e-commerce stock hiding inside the Chinese tech sector. Now, let's talk about one of the biggest questions every investor has. What could JD.com's share price look like after the buyback plan is completed? First, JD has authorized one of the largest repurchase programs in its history, a combined $8 billion US, or about 62 billion Hong Kong dollars, running through 2027. For context, JD's entire market cap today is only around 340 billion Hong Kong dollars. So the company is preparing to buy back nearly 18% of its own value. That's enormous. And it signals that management strongly believes the stock is deeply undervalued. Now, let's look at the projections. In the bear case, if sentiment stays weak and JD gets no valuation recovery, even with mild earnings growth, the stock sits around 115 Hong Kong dollars to 125 Hong Kong dollars, basically flat from today. In the base case, JD executes most of the buyback. Earnings grow 15 to 20%, and the P/E rises slightly to 11 times. That pushes the stock to around 150 Hong Kong dollars to 160 Hong Kong dollars, about 30% upside. And in the bull case, strong recovery, higher margins, and a return of investor confidence could lift JD to a 12 times multiple with 25 to 30% EPS growth. That puts the price between 180 Hong Kong dollars and 190 Hong Kong dollars, roughly 50 to 60% upside. In short, JD doesn't need explosive growth. With consistent profits, a massive buyback, and even a small valuation re-rating, the stock has meaningful upside potential. Let's look at how JD.com stacks up against its two biggest competitors, Alibaba and Pinduoduo, across valuation, margins, and forward earnings. This table tells a very interesting story. Starting with JD.com, the market is pricing it as the most undervalued of the three. JD's forward P/E is only around 8 to 10 times earnings, far below historical averages. EPS growth does recover in the next few years, but margins remain thin at around 3%. The key point, JD is being valued like a low-growth retailer, even though it's still generating over 1 trillion yuan in revenue and improving profitability. This is where the deep value angle comes from. Next, Alibaba sits in the middle. Its forward EPS estimate shows solid, steady growth as the company restructures, cuts costs, and pushes harder into cloud and AI initiatives. Alibaba trades a forward P/E of about 11 times, which is cheap for its size, but not as depressed as JD. Margins are much stronger, with operating margins around 15% and consistent net profit. Wall Street views Alibaba as a balanced growth plus value opportunity. Then we have Pinduoduo, the strongest performer in terms of margins and profitability. PDD's forward EPS is the highest of the three, and consensus expects more growth on top of already strong numbers. Despite that, PDD trades at roughly 9 to 10 times earnings, a surprisingly low valuation for a company with 30% plus operating margins and rapid global expansion through Temu. This makes PDD the high-growth leader in the group, though with higher expectations and potentially higher volatility. So here's the full picture. JD is the undervalued play, low PE, recovering EPS and sentiment-driven discount. Alibaba is the stable middle ground, solid margins, AI/cloud potential, moderate valuation. PDD is the growth engine, high profitability, strong execution, and aggressive global expansion. Each company sits at a very different point in the risk-reward spectrum, and this table shows exactly why JD, despite being the cheapest, might offer the biggest value to recovery upside for long-term investors. Across more than 10 top analysts, the message is consistent. Every single one has a buy or outperform rating, and their price targets range from 146 Hong Kong dollars on the low end to 233 Hong Kong dollars at the high end. Jefferies is the most bullish with 233 Hong Kong dollars, followed by HDSC at 192 Hong Kong dollars, Goldman Sachs at 174 Hong Kong dollars, and UOBK High-End at 167 Hong Kong dollars. Even the more conservative houses like SBBI still put JD above 146 Hong Kong dollars. When you take all 21 analysts together, the consensus average target is around 165 Hong Kong dollars, which is roughly 40% higher than JD's current trading price. So the takeaway is simple. Analysts across Wall Street and Hong Kong believe JD is deeply undervalued, and an entire range of professional targets points to meaningful upside once fundamentals and buyback start showing in the numbers. So here's the final verdict. When you put everything together, JD's long-term supply chain strategy, improving margins, strong free cash flow, and a massive $8 billion buyback, one thing becomes clear. JD is not a broken company. It's a mis-price company. It trades at single-digit PE, near book value, with over 200 billion renminbi in cash and a logistics network that would take competitors decades to replicate. Yet the market still values JD like a slow-growth retailer instead of the national tech logistics infrastructure it has become. If JD retires up to 18% of its shares, even modest earnings growth and a small valuation recovery can push the stock into the 150 to 190 Hong Kong dollars range, roughly 30% to 60% upside. And the analysts agree. Goldman Sachs, Jefferies, UOBK High-End DBS, over 20 research houses, all have targets well above today's price. Yes, China's macro outlook is uncertain and competition is intense. But investors are being paid for that risk through JD's cheap valuation, rising EPS, strong cash reserves, and continuous buybacks. So the conclusion is simple. JD.com is a high-moat, cash-rich, deeply undervalued business entering a multi-year profitability recovery, and the market hasn't fully caught up yet. If you enjoyed this breakdown, hit the like button, share your thought below, and subscribe for more data-driven deep dives.